Welcome to Investors Insights, where today's topic is valuations and expectations. Ty and I had a really good conversation this morning about expectations on the market and the valuations. Ty, I appreciate you coming in with a lot of research on market valuations. For those that watch our educational vlogs, we recently did one on inflation and the market valuations price to earnings ratio. And I think that's what Ty's going to be talking to. And what we did that topic is more long-term, how inflation long-term impacts. So this is a really good week for us to bring this up because we're going to get a new look at what consumer price index inflation is this week. Tomorrow we'll get the CPI, and then later this week we'll get the PPI, which is the producer price index. Now, last month when we got the CPI, it came in hotter than expected, a little bit higher, and the markets really took that negatively and traded off drastically on that news. And so we'll see what the market expects this month. Current projections are for, again, 3.1%, which is what it was last month. So no news up or down. So it's really where it goes from here and how the market reacts. This will be the last large data point before the Fed meets on March 20th. And so inflation and expectations is really driving the Fed. The Fed has said they're very data dependent, and this is the data they're talking about. And so we feel like this will drive markets. But it's not about just the where the CPI is. It's about where it is versus expectations. And then in the long run, this impacts valuations. How many times are investors willing to pay for a single dollar of earnings? That's based on the valuation. So Ty, thank you for bringing that to our attention this morning. What do the valuations say long term?
I think it's been, the market's had a great run up. Everyone's kind of seen it. You hear about it a lot on the news, and a lot of people are saying that the market is overvalued. And, by some historical metrics, that's not entirely false. But as you see in this scatter plot here, this goes back to 1990. On the x-axis is price to earnings ratios for the entire S&P, and then on the y-axis is subsequent one-year return. The dots are kind of everywhere. There's no real rhyme or reason for it, and that's for a reason. In the short term, valuations don't necessarily predict market performance leading up to the future. So the market can be overvalued for a while, or it can be undervalued for a while, and vice versa. But as you see here in this next chart, the dots are in a nice organized kind of line here. And this is for the next 10 years. And so where we are is kind of around the 23 mark. And as you see in this chart, that leads to about kind of flat returns. And so I think it's important to kind of talk about active management and look for opportunities in the market going forward. With that being said, past performance doesn't, necessarily mean, future results. But at the same time, just important to know kind of where we are and where we could be in the next few years.
Excellent. Thank you very much, Ty. Yeah, so all this is something we watch on a day-to-day and a week-to-week basis, but it's very important to pull things back and look at the long term because that's where valuations matter. That's where earnings matter. That's where really the big picture and planning and long-term planning really pay off. So we hope you found this information helpful this week. As always, please don't hesitate to call or email us. If you have any questions, you can follow us on Facebook, LinkedIn, and Twitter. Never hesitate to call. I hope you have a great week. Thank you very much.